Felix here. The Fed has just been given the economic blueprint to weasel its way out of the disaster that it has caused. The Canadian Bank of Canada has paused their rate hikes. Now, the Canadians were the first to kick off this insane cycle of rate hikes. And let me show you exactly what that looks like and what that is all about. Of course, none of the following is financial advice. You know that by now. Let me show you the chart here. So the green line is the Canadian interest rate. The orange line in the background is the US interest rate. And the Canadians were just a little earlier to the party with this insane level of rate increases. What do they say, Justin? Why does it matter? Because it is somewhat of a leading indicator. And they said, look, the ongoing program of quantitative tightening, and this is going to be, I think, very similar to the phrasing we're going to see on the 1st of February, which is the FOMC meeting and the biggest event we have in February. The quantitative tightening, so the money shredding, is complementing the restrictive stance of policy, the policy rate. If economic developments evolve broadly in line with our outlook, we expect to hold the rate at its current level, so no more interest rate hikes there. The bank is prepared, however, and I think this might also be a phrase we're going to get next week, prepared to increase the policy rate further if needed to return inflation to the 2% target. So basically saying, we're not going to do anything, but we might possibly do more if the data changes. And then they're saying, look, the slowing 3-month measure of core inflation is evidence of underlying price pressures have peaked, and global supply chain conditions and lower energy prices are also reasons inflation is coming down significantly this year, they say. Now, what's the actual real reason? Now, this is the US federal debt, but the Canadian situation is very similar. The Canadian households are actually incredibly indebted as well. We are at just under $31 trillion debt. I know it's a silly number, but since COVID, they've added about $7 billion on that, 7 trillion, silly number indeed, which is about, 25% or something like that, 20%. So what does that mean? Well, let me show you what it costs the US to service its debt and why it can't afford higher interest rates for much longer. The net interest on debt at the moment is $500 billion. That's slightly less than the defense budget. It's 1/3 of the Medicare budget. You keep interest rates higher for longer, and I mean longer past the end of this year, and this interest number starts to exceed the Department of Defense's budget. And I think one or two people might have something to say about that. Northrop Grantham or whatever they're called, reporting. So today, tomorrow, they want the money. They don't want to give it to people holding government debt now, do they? But there is a bit more to it. Let's understand what the market priced in expectations are for the Fed's rate moves for the coming quarters and coming months. Before we do that, if you haven't already signed up to our free masterclass held this Saturday, 28th at 11 a.m. Eastern, where I will show you how Wall Street banks trade. And I'll teach you their biggest trade that reduces your risk as an investor by as much as 99%. Seriously, it's insane. I know. I don't know why people don't know this, but I'll teach you. It'll be free. Go to felixfranceblog.com/secret. There were about 150 spots left last time I looked, and they'll be gone within a day or so. So sign up for that. felixfranceblog.com/secret. Links also down below. There it is. And also in the description, so you don't have to type. I know not everybody can type. Education nowadays, kidding. All right, so what have we got? Well, for the February meeting, which is just in a short week, the entire market, 97.2%. So everybody but, I don't know, Nancy Pelosi are expecting, did you see that New York Times article on her? It was like her granddaughter wrote it or something. Never mind. Moving on, basically, everybody expects us to get a 0.25% rate hike here on the 1st. No surprises there. Now, that's a big change from a month ago where only 2/3 of the market expected that, but, that's where we are. Now, what about March? Well, in March, 78% of the market thinks we're going to get another 0.25 point hike, and 19% who are very optimistic or drunk think it's going to be 0%. Now, the real question is how high? So if you go into, say, May forecasts, and these are not forecasts, these are actually traded instruments. So it's not like, we polled a few befuddled drunk Wall Street bankers or something. No, this is actually market data. So the market, 56% of the markets, that's the majority, expects us to peak at the March hike. So basically from where we are right now, we get another 0.5%, and that's it. Done, basta, the end of the thing. 30% are pessimists and are sitting on a window ledge somewhere in a high tower, and they think it's going to go possibly a little higher. But it's not just about how high, it's very much how long, because the longer this lasts, the more people have their fixed interest rates on their borrowing expire. The more companies have their fixed, revolving whatever bank facilities they have expire, rates go up. The longer this goes on for, the higher the pain, and also the higher the pain for the federal government. So if you go into September of this year, look, we're back to 475,500. And if you look at where we were in May, 475,500. So the market, broadly speaking, expects us to stay there. But there is a small but strong gathering here of the market that is about 43% now that actually thinks in September we're going to get our first cut. And the further you go out towards the end of the year, the higher that percentage gets. So the market is looking for a Q3, but definitely a Q4 rate cut. That's what's priced in. So the really interesting story is, first of all, what does it do to your growth portfolio? But what does the Fed allude to in terms of timeline when they're going to start revising this again? Now, what's going to benefit from lower interest rates? Well, anybody who owns bonds, quite frankly, they're going to have made a pocket, which is what we were talking about a couple of weeks back, but also growth stocks. Growth stocks are the most rate sensitive, especially the non-profitable growth stocks are the most rate sensitive. Why? Because they are evaluated on something we call basically free cash flow. Essentially, it's about free cash flow. So we discount that free cash flow on the basis of interest rates. So a cut by 1% of the interest rate gives us a approximately 10% boom in growth stocks, which is why growth stocks tend to come out of recessions a little earlier than the rest of the market. I'm not saying you should throw all your money at growth stocks. A lot of you, I think, are fairly heavily weighed down by growth stocks, but that's kind of why we are excited about this. The other thing we're, of course, excited about is trading, the up and the downs and the volatility and everything else. And this is my trading performance in the last 2022. We're up 126% on capital employed. And if you want to know how I did that, then just jump on a phone call with us. Literally, we'll walk you through it and what it all means, and whether we can help you do with it, we can teach you it, and whether it's something that will be beneficial to you. Go to felixfranceorg.com/coaching. Just book a call. What do you need for it? Well, you need a 5-figure portfolio. Otherwise, it doesn't really make sense to join our coaching program. So if you are newer to investing, portfolios at the smaller level, check out the course at felixfranceorg.com/options. Again, what do you get? Well, you get all my strategy. You see exactly what I do. You get to watch me trade live. You get to see me ping my trades to you. You get unlimited chat support and tons of other goodies in a marvelous community of absolutely wonderful people. There we are. That's it from me. What do you think the Fed's going to do on the 1st? Do you think they're going to follow the slightly colder cousins up north and pause? I doubt it. My money would be on the 0.25% hike still. But it really is the language, is the speech that Jay Powell's going to give, and I'll live stream that for you guys and give you some commentary on it next week. That's really, I think, where the juice is. And if he is in a good mood, we're going to get a really nice squeeze up here in the market. Or if he hits us really hard, then it obviously turns things around and we go south again. And this whole squeeze of 2023 will be over. There we go. Thanks very much for watching. I appreciate you tuning in.